get into the outlook for the industry, so I mean, this is not really news, but the industry has been through a very difficult cycle over the last couple of years. Things are getting better, but I think the industry is still obviously struggling. There's still margins are still very low in a lot of markets, but we do see market drivers getting better. So that's a good sign. Because the second theme that I'd like you to better understand today a little bit is because margins are low, we are seeing a lot of capacity rationalization. A lot of capacity is being shut down. Capacity utilization rates are already down. And the challenge here, though, is that we don't see the same thing happening in China, for example, which is one of the largest, which has one of the largest amount of capacity in the chemical industry today. China continues to add capacity. China continues to run some of these assets at relatively high utilization rates, and as a result, a lot of that product is being dumped into markets around the world. We were at dinner yesterday, and I was talking to somebody who had just returned from the Middle East, and they were being told about how much chemicals are being dumped at incredibly low prices, for example, in the Middle East. Similar story, I was talking to Marcus, who was talking about experiences in talking to customers, for example, in Asia, South Korea, Japan, and how they are under tremendous pressure, for example, from the Chinese. So there's, if we think that there's pressure that we are seeing in North America or in Europe, the kind of pressure that Asia and Japan and Korea are in general from Chinese chemical capacity is just very hard to understand for us here. So I think that China continues to add capacity, and that's going to be a key issue here. The third, US continues to be very fortunate in terms of the advantage that it has in terms of feedstocks for oil and gas, especially ethane, natural gas liquids. We actually are not fully leveraging the advantage because we just don't have sufficient capacity to take advantage of all of that. So therefore, we are exporting a lot of ethane and LPG to overseas markets, as I talked about on Oil and Gas Day. But that advantage continues. That advantage has positioned the US fairly well. Obviously, tariffs are not going to be helpful. If there's a consistent theme across these 3 days, it's that tariffs are not going to be helpful in any way. Now, in the chemical industry, because China has built so much capacity, so polyamides is a good example. We were talking about that here with one of my colleagues, we expect some of these markets will potentially benefit, right? Polyamide producers, for example, in the US could benefit from tariffs on polyamide production in China, for example. But broadly speaking, right, these are fairly isolated cases where you'll see some benefits. Broadly speaking, tariffs are not going to be helpful for the industry. Because of the slump in the chemical industry, recycling has also struggled and suffered. Virgin plastics today are cheaper than recycled materials, so that's not helpful in terms of adoption. And then finally, there's significant amount of innovation that will need to happen. The industry has been going through some sort of a restructuring process, which we expect will continue. This will include capacity rationalization. This will be reduction of SG&A costs and things like that. But companies will have to really think about innovating on technology and the business as well, because on the business models as well, because otherwise it's going to be very hard to survive here going forward. So we'll talk a little bit about some of those things as well. So let's talk a little bit quickly at a high level, right? We've been showing a version of this chart for many years where we look at how the chemical industry overall has performed in terms of shareholder returns. And that's the chart on the left. And historically, chemicals has always done better than the market overall. But starting last year, the chemical industry has been subperforming the overall market, and total shareholder returns are much lower now. And we see that obviously in the 5-year returns, but these returns in the last couple of years have been so bad that even the 10-year return now looks worse than the market. So the industry has gone through a very challenging time. The chemical industry, to a large extent, is driven by GDP growth because chemicals are used essentially by everybody, people like you and me all around the world, right? So as the overall GDP kind of grows, chemical industry kind of goes with it. The last couple of years, GDP growth has been choppy globally and regionally, of course, but that is getting a little better. I think since last year, we have seen an improvement globally and in most regional markets in terms of GDP growth. So in that sense, it's a neutral environment. But then if you look at inflation, if you look at interest rates, especially for new capacity additions, if you look at overall feedstock cost competitiveness, which is in terms of, for example, oil prices, which because a lot of chemical production globally is driven by naphtha, which comes from oil, or you look at the emergence of new markets. Across all of those metrics, we see green shoots, we see growth opportunities there. So in that sense, the drivers for the chemical industry are getting better. Around broader themes like sustainability, decarbonization, probably the environment is not as optimistic as it was a few years ago, but overall, right, on a relative impact for the chemical industry, we think it's a neutral outlook here. I'll go through this quickly here, but obviously, GDP growth is getting better. We are obviously past that significant rebound that we saw coming out of COVID, and we are getting to more of a stable outlook for GDP. Automotive sales here in the US are improving. We were a little above 15 million units of automotive sales here in 2023. Last year we got to 16 million. This year we expect it to be a little over 16 million units, right? A lot of chemicals go into automobiles, and then that's going to be a key driver. Another place where a lot of chemicals and materials go is the housing market. The housing market has actually declined over the last couple of years in terms of housing starts, but we expect a little bit of growth here this year. And then US chemical exports actually have struggled in the last few years. We saw a significant decline in 2023. From that decline, it has grown up a little bit, but we are still not at the point where we were, let's say, in 2022 or so. But overall, a relatively better story. Inflation's coming down. This is helpful because it allows more disposable income for people to buy stuff. And when people buy stuff, then you essentially sell more chemicals. But having said that, inflation in some key markets, China is a good example, continues to be a challenge. And as the domestic market for China grows, a lot of chemical demand in China will focus on serving the domestic demand. But without that domestic demand growing, China will have to export a lot of capacity overseas, which hurts chemical producers, for example, overseas. So therefore, looking at what happens to inflation in China is also equally important. Tariffs are obviously, again, not going to be helpful here. Interest rates drive capacity additions in a lot of markets around the world. Interest rates have been high, and as a result, we have seen a depression in capital investments in a wide range of markets. We expect some of that to change. There are there are interesting growth trends that we see, for example, in data centers, electronic chemicals. The tech industry is spending an incredible amount of capital. I was seeing some story out there that the amount of capital that the tech industry, so this is Google, Microsoft, Amazon, Facebook, that the amount of capital that they are investing in data centers today matches the amount of capital that the shale industry invested at its peak in 2014. So, and the tech industry hasn't invested this kind of capital in the last 10 years. All of that is going to drive demand for a wide range of materials and chemicals for the industry. But broadly speaking, falling interest rates are supportive. Broad-based drivers like, what's happening to housing, what's happening to investments in houses that consumers make, and then the strength of the mix of the population, right? All of these help contribute to growth for the US chemical industry. So going forward, right, we expect somewhere between 1.5% to 3% growth in the chemical industry here. At 1.5%, it's a little below GDP, so that's probably more of a pessimistic outlook. That's our low case. So conceptually, we should expect somewhere in the middle in terms of what we expect in growth going forward. If you take that growth and break it down and say, where is that growth occurring? A lot of that we expect to be in the petrochemicals space, in bulk petrochemicals. And then you have a bunch of other markets that are all somewhat positioned similar: plastic resins, specialty chemicals, ag-based chemicals, and things like that. So that's where we see growth here going forward. So this is the picture that's been the most worrisome for a lot of people in the industry. This is margins for various plastics. We have polyethylene, polypropylene, PVC, and polyester value chain. And the dashed red line is the 5-year average, right? And essentially, you see where margins today are relative to what that 5-year historical average looks like. Polyethylene is about 25% down, polypropylene is about 35% down, PVC is another 20%, polyester is about 15%. And that's the problem really, right? I mean, this is why the industry is struggling. These margins are significantly lower than what the industry is used to. And in comparison, the cost structures of the industry haven't quite responded to these margins. So because of this, a lot of ethylene capacity is not being utilized. The chart here on the left shows the utilization rate. About 80%, 81% of industry's ethylene capacity is being utilized, which is quite low from industry, in terms of historical industry standards, and about 20% is unutilized. We do not expect the utilization rate to change in any significant fashion over the next few years, at least the next 3 years. What that means is that a lot of ethylene capacity is at risk of closure. Actually, a lot of the work that we have done in the last couple of years has been trying to understand what ethylene capacity is more likely to shut down versus others. And so that's what we're trying to show in the chart on the right. Essentially, ethylene capacity that is fed either by naphtha, so these are small ethylene plants that are fed by naphtha, or these are ethylene plants that are, let's say, fed by coal-based feedstock. That's the capacity that is at risk of closure here going forward. In spite of that, the industry continues to spend capital in growth, and a lot of that capital investment in additional capacity is coming in Asia Pacific, which is that blue stack that you see in the chart here. Actually, overall capital flows into the chemical industry are a little higher than what we saw, let's say, into the industry in the years prior to the pandemic. And if you look at where this capacity growth is occurring, a lot of that is happening in China, right? In fact, Chinese ethylene capacity, propylene capacity is growing at a little over 5%. So that's the problem, right? China continues to invest in capacity in the chemical industry while overall demand drivers continue to be fairly challenging. US continues to be advantaged from a feedstock point of view, this is natural gas prices. There's no better place than the US if you want to build a new chemical plant based purely on solid economic fundamentals, right? The feedstock is available, it's cheap, it's plentiful. We expect fairly stable prices here going forward. Broadly speaking, this will continue to be an advantage. There's plentiful supplies of ethane. These are ethane margins, ethane to ethylene margins here. In the US, we have seen a little bit of improvement in 2024, but still fairly low margins. Now, what is interesting is that the margins that we see are similar to, for example, the margins that we saw during COVID, right? So that kind of tells you the advantage that US has from feedstock point of view. We don't quite see the same picture in Europe, for example. So this is a view of ethylene cracking capacity and what has happened to those ethylene crackers globally. In the US, we have seen a reduction in capacity, temporary reduction in capacity by essentially taking turnarounds and things like that. In Europe, though, we have seen a lot of ethylene crackers essentially being shut down, primarily because of poor margins, right? And of course, we continue to see new capacity additions in Asia, right? So that's the broad picture overall that you see globally in terms of what is happening to ethylene capacity. So essentially, Europe's really struggling here when it comes to chemicals. And of course, the high cost of energy is one of the key challenges. So what does that mean, right? What that means is that Europe's contribution to the global product mix in terms of chemicals and plastics is declining. So there's a lot of data here, but if you look at the top right chart, the share of Europe in the polyethylene demand space, so that is coming down. And in comparison, if you look at capacity, we are seeing a reduction there as well. But demand continues to grow, so essentially Europe is falling short relative to overall demand, and a lot of that demand, especially in polyethylene, is being met by exports out of the US. So levying tariffs and the resulting retaliatory tariffs on the industry will not be supportive for US chemical producers. Now, in some cases, it would be helpful. Nylon is a good example. So here we are showing the price differential between US and Chinese nylon prices, and it's a ridiculous number there. It's almost $1,500 a ton. So essentially, Chinese nylon 6/6 is $1,500 a ton cheaper than US produced product, right? So this is unsustainable, right? And conceptually, tariffs could help this, but only to a certain extent, right? But overall, we expect tariffs to be not supportive for the industry. The other piece is that we are now seeing an interesting dynamic emerge, right? Which is that the US is now exporting a lot of petrochemical feedstock, ethane and LPG in particular, and a lot of that is going to China. We are now seeing new Chinese ethylene crackers that are being built primarily on the basis that they are going to import ethane from the US. So essentially, there is this dependence for these ethylene crackers on feedstock from the US. And so now it's a question of what is the US going to prioritize, right? Is it going to prioritize the export of feedstocks for petrochemicals in China, or is it going to support and develop economic policies that will be helpful for the polyethylene producers here, for example? So this is a difficult problem for policymakers to address, right? What do you prioritize? If you look at it purely from an economic basis, the economic value of ethane exports, LPG exports is much, much higher than the economic value associated with polyethylene or polypropylene, mainly polyethylene exports out of the US. But what is interesting is that if you export ethane, you are creating a significant margin advantage for Chinese ethylene crackers, which we are trying to show in the chart on the right. China is importing a lot of ethane. A lot of it is coming from the US. And when they do that, those crackers enjoy a $300 to $500 margin advantage, essentially leveraging US feedstock. Conceptually, if there are retaliatory tariffs on ethane and propane LPG exports. The impact on the petrochemical industry could be helpful in the sense that now this feedstock becomes cheaper, but it doesn't get cheaper enough that it dramatically changes the competitive positioning of US chemical industry. Primarily because US still has to export, US still has to find demand, and right now a key problem in the industry is demand for product as opposed to necessarily feedstock challenges. So it's a fairly complicated and challenging picture here to manage, because unless demand really starts picking up, it'll be difficult for a lot of ethylene capacity globally to be competitive. But in the near term, right, if there are tariffs, right, what happens to ethane and propane exports? We think that there may be an opportunity for ethane to potentially, for LPG to potentially find other markets. But in the case of ethane, it's going to be challenging because there are not a lot of outlets for those molecules. Let's talk very quickly about recycling. The plastics treaty, the Global Plastics Treaty, did not come to fruition. The negotiations will continue here, and there are lots of challenges here, right? There are many countries that want a ban, for example, on single-use plastics. There are many countries that want a cap on how much plastics can be produced by large chemical companies and by different countries. The large chemicals and plastics producers obviously are not in support of a cap on production levels. So there are lots of thorny issues that will have to be resolved. So one will have to see where this goes. But at this point of time, when we looked at this last year in our outlook, we saw this as a key headwind for the industry, but we don't see that as a critical headwind right now. We think this is going to take a much longer time in terms of getting to some sort of resolution. We also think that the resolution is probably not going to be as punishing as originally expected. But broadly speaking, today, recycled materials are more expensive than virgin plastic, primarily because the industry is in such a difficult shape that the prices of virgin materials have fallen. It's not as if recycled materials have become more expensive. But when recycled materials are more expensive, you obviously don't have the ability to drive adoption, right? People will buy virgin plastics. So we talked, actually, Charles Sherrington yesterday talked about this. He said that the worst performers in his portfolio, a private equity portfolio, were investments made in and around plastics recycling. And some of that is because virgin plastics are today so much cheaper. Having said that, we continue to see growth in markets. We think that recycled polypropylene will grow, for example, here. But of course, there are other challenges, right? The collection, the broader infrastructure that you need for recycling, collection, sorting, processing, all of those continue to be areas where further investments have to be made. And without that, it's going to be harder for us to drive further adoption. So how have chemical companies been responding, right? I mean, there's obviously a lot of restructuring going on in the industry. And chemical companies are also positioning their portfolios where they can focus on their core businesses, or are acquiring businesses that allow them to compete more effectively in high growth segments. As part of the decision to focus on core assets, they are divesting some assets. So for example, Lyondell acquired APK that allows them a better footprint, for example, in recycling. BASF divested its XPS business, for example. So there's a lot of divestitures happening in markets and segments that are not seen as core. Finally, we are seeing new approaches in terms of looking at assets and evaluating their fit for purpose for different companies. So there's a very interesting transaction that happened recently where Dow and Macquarie spun off all of their chemical pipeline assets into a separate infrastructure business. Dow and Macquarie own different stakes in the business, but to a large extent, that's now a standalone entity, primarily because Dow believes that those assets don't help them with the kinds of returns that investors expect from their chemical assets, right? So we see these kinds of interesting deals and restructuring that is happening in the industry, and we expect some of this to continue. Data centers, we think this will be supportive. We talked about this a little bit, but there's a lot of stuff that goes into data centers, right? I mean, these data centers need switchgear, storage, cables, and all of these use chemicals and materials of various kinds, traditional commodity polymers, engineered polymers, high performance polymers. All of these markets should benefit from this growth that we see. We should see similar growth coming out of electric vehicle sales as well, although some of that is slowing down, and some of that demand growth is shifting to China. So electric vehicle growth today is much faster in China than it is in, let's say, North America or Europe, and correspondingly, there's a lot of chemical capacity in China. So that's the capacity that is being tapped into to serve that growth in electric vehicles. So we expect growth, but this has significant regional imbalances that could actually hurt North American and European producers. We see a lot of growth in new materials and markets. For example, across, say, energy storage is a good example, right? I mean, yesterday we talked about how rapidly energy storage is growing. So as a result, some of the materials that we need for energy storage are going to grow rapidly, over 5% returns, for example. But at the same time, there's a lot of pressure on these companies to reduce their carbon intensity, to reduce capital costs, because a lot of the growth in energy storage is happening because batteries are getting cheaper. If batteries are getting cheaper, that means there's pressure on the supply chain to make inputs into the supply chain cheaper. So essentially, a lot of traditional processes to make these materials are being examined very closely, and people are saying, okay, the traditional ways to make fumed silica or silicon or some of the other battery materials are too polluting from a GHG footprint point of view, have very high capex, very high opex. So there's a lot of innovation that is focused on trying to make these processes a lot more competitive across some of these metrics. So a lot of this will require a new approach in terms of how companies approach innovation in traditional markets as they are growing. Some of the markets that are tied more to traditional oil and gas applications, so catalysts, for example, is a good example. Catalysts to make ethylene, propylene, gasoline, they're under a lot of pressure because these end markets are facing significant disruption. So these markets are now going to grow at a much slower pace. On-purpose propylene has grown for the last few years at about 10% annually. We expect that to decline dramatically. So as that happens, catalyst vendors, the mix of their business is going to change. Instead of first fills, a lot of that is going to be essentially replacing existing catalyst volumes. Is essentially going to be the refill business. So when that happens, the approach, the go-to-market strategy has to change. First fills, you can work with a lot of EPCs, a lot of licensors, and secure that business. Refills, you need to be talking to unit engineers, you need to be talking to technical service staff, and a lot of these catalyst companies aren't quite set up for that. They'll have to invest in digital tools that gives them insight on a day-to-day basis on how their catalyst is performing, and they need to provide technical service. So that business model has to change for them to compete in this new environment. And finally, it feels when you look at the data that the US is losing its edge when it comes to innovation in the chemical industry. Again, I forget with whom I was talking about this. I think, again, it was at dinner yesterday, and I think, Marcus, you were talking about, it's not just that Chinese products are cheap, but they are incredibly good. I've heard this comment so many times that Chinese EVs actually provide a better customer experience than Tesla, for example, does to customers. That, to me, tells you is a very worrisome sign. That tells you that we are losing the innovation, the edge when it comes to innovation, and the data kind of shows you that, right? Like the amount of R&D spending, for example, in chemicals in China has increase substantively. It outperforms it outspends all the other markets when it comes to spending. And I think that tells us that, there is a lot of capacity that they're building, but a lot of they're also innovating on a lot of areas when it comes to the chemical industry. So it's a serious concern for the broader industry. So that's what I have today. Happy to take some questions. We're running a few minutes behind, but we'll catch up here shortly.
Thank you, Uday. How do you see the outlook for aromatics and naphthalenes in the chemical feedstocks market?
Yeah, broadly speaking, I think the aromatics value chain, so actually if you saw the polyester value chain, for example, the margins, there's still a difference relative to the 5-year average, but it's a little bit better, right? But broadly speaking, I think the aromatics and aromatics derivatives are probably a little better positioned because alternative feedstocks for them are difficult to find. Those markets relatively have applications in fairly specialized end markets, so there's some protection there. And then a lot of the feedstock is coming from essentially oil and gas, right? Refineries, catalytic naphtha reformers, or extraction of benzene, toluene, and xylene from different hydrocarbon streams. Because oil is getting cheaper, some of those feedstocks should get cheaper, and companies that have the asset base to extract those aromatics should be well positioned. So I think the broader outlook is a little better than, let's say, what we see for the olefins.
Thank you there for this information. It might sound like a dumb question, but you said virgin plastics are cheaper than recycled ones. And how about like the carbon intensity, or does premium exist in any part of the world for recycled plastics?
I think not at this point of time. I'm looking at my colleague Panusvi here, but I don't think there's a premium. And I think even in the past, the premium has been fairly small. So that's been one of the challenges, right? That end markets don't want to pay a premium just for recycled product, right? There might be some end markets, but they're very small, right? Emollients, for example, that are used in face creams and all that. Maybe there's a little bit of, but those are like very small. In most of the large volume applications, so think of shampoo bottles, or P&G trying to buy other plastic packaging, or Pepsi buying other plastic packaging. There's not a willingness to pay a premium for that.
Thanks, Uday. I had a question related to, you were talking about the trade war could also hurt Asian imports for ethane from the US. So if there's such a differential of buying the ethane from the US versus you cracking naphtha on that, what's their next best alternative?
Next best alternative to shipping NGLs, or?
Well, if a tariff is there, it's still, that premium is still there for them. It's a smaller premium, right?
You mean the premium in margins that they are seeing? So let's say you're a Chinese ethylene cracker, you're importing ethane from the US, you see a slightly higher margin than, let's say, a naphtha-based cracker in China. That premium will still exist if they, so if you have a 25% tariff, then that margin premium comes down a little bit, but there is still a premium. Yes.
Right. So it really probably wouldn't have as big of an impact on U.S. exports then, in that case.
Yeah. So I think the way the tariffs will work is producers that are facing relatively competitive or limited markets, which would be the case here. So if you're, let's say, an ethane producer, right? There's not a lot of places that you can sell ethane to. It's the Chinese, or it's the Asian crackers, or it's the European crackers. And how much ethane you can sell is also limited by how much export capacity you have. So, and a lot of that export capacity is not full. So essentially what producers will do is discount the prices to the point where they can still basically eat the cost of the tariff into those markets. Now, with the case of ethane though, right, if the price difference between ethane and natural gas is not enough to cover the cost of separating it, then people just reject ethane into natural gas streams. So then essentially you have more natural gas production, natural gas prices fall, which also, now in most cases, the ethane producer and the gas producer is the same entity, right? Usually they're the same set of companies. So essentially for them, it's a trade-off between like, okay, what do I, where am I going to get the most return? But broadly speaking, it's not helpful, right? I mean, it basically depresses prices for US producers. Well, we'll go into the plastics polyolefins panel. I'm really looking forward to this discussion. A lot of interesting perspectives here.